Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, March the 25th, 2025, recording this in the morning. We'll do a fairly quick one today, guys, because the markets are relatively quiet. What we did see yesterday, there was a little bit of risk on, and that was just because of that Bloomberg article over the weekend, just essentially saying that Trump would maybe just be a bit more targeted and not put sort of universal tariffs on everyone. And indeed, Trump himself yesterday did say that there'd be quite a lot of exemptions and exceptions here and there. So let's see what happened. We'll see what happens on April the 2nd, the famous Liberation Day. But it does seem as though the tariffs will not be targeted sort of universally in 25%. So the market took that as a positive, that there'd be a lot of negotiations. So we saw that equities are up, which we can just look at in a second. But if we also saw yesterday a bit of sort of data from the US, so in terms of the S&P Global Manufacturing PMI, that was actually down a little bit, but we saw that the services was at 54, so in positive territory, and we see the composite at 53. So if we actually look, we can look at a bit more detail just from the daily shot here. They always have some pretty good charts. So if we see here, it looks like services is doing okay in the US. Again, this is just a survey. And this is just in the context of trying to understand whether the US economy is actually slowing down or not, because there was a lot of pessimism over the last 2, 3, 4 weeks in the narrative that, the US economy was going to collapse and, deficit spending is going to push down the US economy and there's going to be lots of jobs lost because of the initiatives of Doge and, of course, the tariffs themselves. Now, that could still happen. So what we're trying to do at the moment is just to sort of see what's going on. But you can see that the service sector in the US seems to be sort of, not bad at all, 54 compared to 51 expectation. Not in some sort of clear uptrend, but sort of hovering in positive territory. If you look at services employment, that came in at 50.0, 50.9, so that's not too bad. You look at input prices, they're going up. But really the problem seems to be is manufacturing PMIs. And you see that came in under 50, so under the survey expectations as well. I mean, it's not sort of, look at COVID here. It's not as though it's collapsing down to the early 40s or something, but it seems to be sort of just holding around that sort of, 49, 50, 51 area. So finding it a little bit difficult to go up. And if you actually look at the employment situation for manufacturing PMIs, that's actually, that is definitely in some kind of slow grind downwards. And again, a lot of the Trump tariffs are focused and targeted at trying to bring back sort of manufacturing jobs and the industry and improving the industrial base. So we'll see how we go with that. But basically what we're seeing is that it's not perfect in the manufacturing sector. You see here input prices are going up. So you have employment going down, input prices are going up, and the actual sort of is an overall sort of index itself are slowly grinding down, whereas the services sector seems to be sort of okay. So having said that, the market, if we look at, let's say, the S&P 500 as a kind of a proxy here, we can see that it's had a pretty big bounce off that sort of Fibonacci level down at 55.20. And again, just because the PMIs were reasonable and Trump essentially signaling that there'd be all kinds of exceptions, etc., for the tariffs. So there was a risk on tone. And what we're seeing this morning is not as strong, but overnight that continues just to grind upwards. So at this point, we're in a sort of a technical market. The real question here is, what's going on? So at this point, if you look at let's say a Fibonacci kind of, just to get our bearings here, we can see that if we look from let's say the 19th of February down to the 13th of March, the low here, we can see that we've breached a couple of technical things, which is pretty good. We've gone above the 200-day simple and exponential moving average. This is the exponential, the simple's up here a little bit, so that's a positive. We've also gone above the 38% retracement. That's a positive. So we're grinding our way up here towards the 100-day EMA, which is also sort of like the 50% fib level, and it's also a little bit of horizontal resistance. So this is going to be a pretty interesting level around about 58.70 on the ES. Now, if we look at the SPX, which is the cash index, of course, we can see that a similar kind of price action above the 200-day moving average, grinding back up into the 38% fib retracement level. Sort of not bad, but have we broken out of the downtrend? I guess you could say that we're, sort of starting to come back out of this sort of downtrend. But at this point, again, we do have some resistance On the SPX, it's going to be at about 58.57. Let's call it 58.60, something like that, which is going to be a conjunction of sort of horizontal resistance and also a 100-day moving average. So that's probably going to be the most important one to see. And I would say for me, to say that this is going to turn into sort of another bull run, just from a technical point of view, I'd probably want to see this going above the 61.8% fib retracement. So let's say above 5,900 on SPX, which would also be above the 100-day moving average. We shall see. We don't have a huge amount of data until later in the week. We get a PCE and a few things. Today we have, I think, Williams speaking from the Fed. So there's not a lot to stop this at the moment. There is sort of a positivity, and until and unless we get sort of maybe negativity from the Trump administration comments, this can maybe just sort of grind up a little bit. We shall see. In terms of the NDX, a similar kind of situation here. As you can see, not quite as strong a starting point as the SPY, but still doing pretty well. The equal weight RSP also doing quite well. So the breadth is fine. The Mag 7 actually doing okay. So all in all, a pretty strong sort of a day in the last couple of days, sort of risk on, just on hope that the Trump situation will not disturb the global trade too much. If we look over in Europe, which actually had a little bit of negativity, coming back pretty strongly overnight here. You see here, this is the Euro Stoxx 50. We also can look at the German index here, which is also looks like it wants to kind of test new highs. And that's also because we had the IFO, which is kind of like the sentiment index over in Germany, and that was a little higher than expected in the late, sort of in the high sort of 80s. So, a little bit positive. So maybe what's happening here is that, that speak about sort of the infrastructure spending, the defense spending, that's starting to filter over into sort of sentiment in the German industrial sector, as reflected in the IFO sort of numbers overnight. And that's looking like stocks there want to sort of push up. So in sort of opposition to that, we can see that the German bonds, so if we just look, let's say it looks something like the Bund, that's actually just going down again. And will this just turn out to have been a little sort of retracement here? So if we just look on a sort of a fib here, we can see that it didn't even muster up, at 38%. I was looking for something more like about 129, but it couldn't even get up there. We can also see that all of the moving averages here are still very much pointed in a negative direction. So it could be, I mean, if you like sort of Fibonacci extension measured moves, the Fibonacci extension measured move here on the in terms of the price on the June contract for the German Bund could get down, even down to, let's say, 125, 124, 123. So down here somewhere. So there's definitely more downside, from a technical perspective there. We also see at the long end, the books, or the 30-year, also having a pretty significant, sort of negative price action there. Over in Italy, just keeping an eye on sort of the Italian bonds, the PIGs, also down a little bit, but not quite as much. But that spread between Italy and Germany is holding pretty constant at around, anything between about 105 and 110 basis points. And the reason I'm interested in that is just that because there's been a lot of commentary, a lot of people saying that, maybe with the German yields going up, that at a certain point there's going to be some contagion into the so-called PIGS nations. So the peripheries like sort of Portugal, Italy, Greece, and Spain. But that, and Ireland, that hasn't actually happened yet as much. And it was interesting for me, at least personally, that the Italian Minister of Finance, Giorgetti, I think it is, he came out in the last 24 hours and essentially said that Italy has to be very prudent. Italy has a lot of debt. Its fiscal situation is a little delicate and sensitive, and therefore they would be very careful about adding too much more debt. And so the market is rewarding Italy here by keeping those spreads contained and actually, keeping the BTPs, the Italian bonds, well supported. And that's because the Italian fiscal authorities, in the shape of Meloni, the prime minister, but also the minister of finance, as I just said, they seem to be quite conservative, and they really don't seem too anxious to be spending a lot more on defense or a lot more on infrastructure. So for those sort of commentators thinking that maybe Italy somehow is going to sort of spend another, $100 billion on defense, I think that they're really signaling that they understand the precarity of their own sort of fiscal situation, trying to keep those spreads down. So as long as we have those spreads contained, there is quite a nice pickup in terms of what you get on the Italian bonds. So if you look at the Italian BTP here, you're getting almost 4%. You're getting about 3.9%. Whereas if you look at, let's say, the German 10-year yield, which is here, you can see you're getting about 2.8%. So the point is there is that sort of pickup of about 110 basis points, and as long as the Italian fiscal authorities remain fiscally sort of disciplined, we can expect that spread to remain tight. However, at the first sign of either internal political sort of problems or sort of fiscal looseness or lack of discipline, that spread will go. That's definitely something I'm sort of keeping a look at. In terms of the bonds, we also saw the US bonds. We'll look at the yields here. We see the yields creeping up a bit. So here's the 2-year yield sort of pushing higher. If we go out to the 10, also pushing higher, and the 30. So all of that pushing higher, just in the idea that maybe Trump's tariffs won't be as disruptive as expected. And secondly, the US economy in the form of the data from the real economy still seems to be okay. And therefore there's no real reason to sort of price in a collapse. That's been reflected a little bit if we look at some of the pricing for the Fed. So if we just go over and see what the Fed funds futures is pricing, let's have a look here. So yeah, so it's interesting just to see, and just keep in mind that we do have the 2-year auction today, and we have the 5s and the 7s over the next few days. So as I mentioned, I think on Monday, which was yesterday, the front of the curve could be under a little bit of pressure just because, the economy seems to be holding up okay. Tariffs not as disruptive potentially. And also, as I say, these auctions. So the front end of the curve, we could see the prices down and the yields up a little bit. So a little bit of flattening, as we just get through this auction period. And in terms of the Fed funds futures here, we can see that what I like to look at is, let's say, December. So that's the end of this year. You can see we're at about 59.8 basis points. Sort of priced in. So that's about 2.4 cuts. And just a couple of different ways of looking at that. We can look at the number of cuts. And if you just look at this, tick chart, so very short term, you can see that we got down, a couple of days ago, we got down to almost 3 cuts. So you see, this is the number of cuts. And that was just based on the fact that, so Powell was perceived to have been, I don't want to say dovish, but at the FOMC sort of press conference, he essentially said that any weakness in the US sort of economy, they would rush in. And so we got a little bit of dovishness there, but subsequently, as you can see, that's been priced back out. And we're now down to about, as I say, about 2.5 cuts, 2.3 cuts there. Not quite as hawkish as we were a few days ago, but certainly a bit of sort of hawkish repricing there. And another way of looking at that, a similar kind of chart, but this one is just not the number of cuts, but the number of basis points. And as you can see, we got down almost to 3 cuts, which is almost 75 basis points a few days ago. But where we are this morning is at about 60 basis points, so just over 2 cuts. So what that means with the 2 cuts, still pricing at about 60 basis points, is that keep in mind that the Fed, in terms of their dot plot, at least the median on their dot plot, they're here at 50 basis points. So one way to think about this is that the Fed, in terms of their dot plot, remember they signaled 2 cuts this year. That would be 50 basis points of cuts, which is this line here. So you can see that the market here is still a little bit more sort of hawkish. So let's just have a look here. And one way we can do this, we look on the Bloomberg here. We've got a function dots. Let's see if we can just bring that up. And so you can see here that this is the end of 2025. And you can see that where the Fed funds futures is, as we just saw, it's the white line here, whereas the median for the Fed is here. So you can see that the market is a little bit more hawkish here than the dot plot. And there's the median. You see most members here. But again, as I've been saying over the last couple of videos, if you look at the totality of the FOMC members, the committee members, you can see that, yes, the median is for 2 cuts, but looks like there are 8 committee members who actually favor only 1 cut or maybe even no cuts. Now, of course, a lot can change. No one really knows what's going to happen to the economy and tariffs and so on over the next few months. But just interesting to keep in mind that although the median is for 2 cuts, there are, quite a significant amount of members who actually are a little bit more hawkish. Of course, there are 2 people who are, slightly more dovish, but at the moment, the market is still a little bit more hawkish than at least the path of the median for the dots. So what that means is that in terms of buying SOFR futures and things like that, maybe potentially for a trade idea, we're still about 10 basis points more expensive, so to speak, than the path of the dot plot. Were these 2 lines to sort of overlap each other and sort of cross, that would indicate that the market has become has caught up in a sense with the Fed dot plot. So they're projecting the same amount of cuts, which is 50. But at the moment, as we can see here, the market is still a little bit more hawkish. Just in terms of other stuff going on, just to get a bit of a sense of also why the equities, if we look here at let's say the futures curve, kind of interesting for volatility. So this is the VIX futures curve. I'm just going to grab some tea, Earl Grey. Bit of Earl Grey this morning. So it's interesting. I haven't really spoken about the vol for a few days, but we can see now that the spot is well below the first VIX futures, which is below the second and the third VIX futures. So the actual spot price is down to 17. And so if we look at, let's say, I don't know, let's say a week ago, you can see that not only has the spot price come down from about 21, let's call it 22 or so. So you see the spot price has come down, but look at the shape of the curve. So you see that the curve, about a week ago was in a backwardated state. So the front part was much more expensive than going sort of further out down the curve. And that's a sign of sort of stress in the short term. And of course, the normal situation is what we now have, which is like sort of a contango situation where the front of the curve is actually lower in price than further out the curve, which of course is the normal sort of healthy situation. Now we're still not down in the teens. We're not down at like a 12 or a 13 or so. So we're still down at semi elevated levels, but we're not in the 20s either. So all of this to say that the volatility has come down a lot, and that's a positive. Another thing I just want to look at here, guys, is just why we've got the Bloomberg open, is the shape of the oil curve. So you see here, oil's picked up a little bit, and we had over the last couple of days some talk from the Trump administration about sort of sanctioning countries or end users who imported Venezuelan oil. So essentially trying to squeeze Venezuela and put the pressure on those who are interacting in the purchase of Venezuelan oil. In theory, that could lead to a little less oil from Venezuela. So the market's quite like that as well. And also just the general risk on tone and the fact that the Trump tariffs may not be as onerous as feared has caused oil to go up. And you see here the shape of the curve here. And again, if we look at, let's say, like a week ago, you can see, so we're in the white. I'll just zoom in here a little bit. So you can see like the white here is, you see the shape of the curve. Like, so obviously the outright price are up at about 69.60. So you see the prices change, but also look at how the shape of the curve, which was relatively flattish, has actually sort of spiked up a little bit, or sort of gone a little bit more into backwardation. So the time spreads are looking pretty good. And if we look at oil, just in terms of the chart action as well, we can see that I've got to say I thought that there could be a chance there of a bear flag. And I have to sort of put my hand up there and say that didn't work out. So I thought this was like a bear flagging formation, which could just come down to retest these lows and stop everyone out. But that hasn't been the case. The good news, or the less bad news, shall we say, on the Trump tariffs, and also the risk on tone, and also sort of potential sanctions more sanctions on Iran and Venezuela. That's enabled the oil market here to push up out of that sort of flagging formation here. So you see the moving averages here, the 200, the 150, and 20. They're all sort of still pointing downwards, but we're starting to get on the shorter term ones just a little bit of an upturn. So what I would suggest, and personally what I'm looking at, is just want to see like some of these sort of technical levels here. So we can look, depending where you draw a fib, we can do the shorter term one. We can see that we've now gone above the 50% fib retracement, and we're starting to come up against the 50-day EMA. So that's a little bit of a sort of a little barrier coming up. And then if you start pushing some of these fib levels up, you see about 50%, that one there only just above the 38%. If we do the main big fib going back to the sort of sell-off from the middle of January, still quite a lot of work to do. So again, not getting too excited here. I think oil will become interesting one way or another if it gets back up into this early 70s. It really has to push up a little bit, I'd say, above some of these moving averages and clear some of these the longer term sort of fib extensions. But so far a nice little bounce on oil, and as we saw, the time spreads are looking quite good. In terms of the other commodities, let's just scroll down here. We see that gold, it's come off a little bit, but again, every time gold's come off for a couple of days, it's been bought. So who knows? Is this about to sort of grind up higher? If we look at the the spot price, we can see that it, sort of touched the top of this big sort of up channel. Again, it's a question if you want to go long gold, we've got sort of, let's say, fib levels sort of looking back down here at 2,900 or so. It's always, to be honest, it's a little tricky at this kind of elevated level to think, where one might want to add or get in. But definitely, it looks as though all retracements are being bought at this point. Silver had a little bit of a bounce, had a bit of a retracement back to a nice level, down to about $33.30. Looks as though that wants to retest highs. Copper has been doing pretty well. As I said, yes, it had a sort of a day down yesterday, but it's got a key hurdle here at 5.2. Let's call it $5.20 here. That's going to be interesting. There's been a lot of okay, so in terms of the tariffs, we saw that a huge amount of physical copper had been imported into the US to try and circumvent the tariffs, or to sort of the front run the potential tariffs on precious metals and industrial metals, specifically copper. But let's see if those copper sort of tariffs don't actually eventuate. We could see copper here. It's a very nice level here, just to kind of sort of backpedal a little bit and maybe sort of come a bit lower. I've put a little sort of ghost thing here. I'm just sort of curious to see whether it kind of pops through and then just has a bit of a pause. But that will also depend just on sort of risk on. Do we get risk on, risk off growth? And also, do we get sort of any more sort of specific information about potential tariffs on copper? Just finally, let's have a quick look at the US dollar here on the Dixie, which we know is 58% euro. Popping, just coming off a little bit again on the risk on tone. We've seen, let's say, for example, the Australian dollar having a little bit of green. We also have the euro sort of up just a little bit. We're also seeing CAD doing better. So this is USD CAD, so US dollar down a little bit against CAD, just in the idea of less tariffs, which of course is good for these risk on currencies. So let's just see, still pretty much still in the range, probably looking for greater clarity. Okay, guys, running a bit late today, so I'll leave it there. Hope that was useful, and have a wonderful day. Thank you.